Picture this. Your phone buzzes, you pick it up, and someone in your life, a coworker, a cousin, a brother-in-law who has a financial opinion ready for every occasion, has sent you a screenshot. Gold just crossed $5,000 an ounce, and underneath the screenshot, 2 words, just 2. You seeing this, and if your money is sitting in real estate right now, something happens in that moment. A specific kind of quiet doubt arrives, the kind that only comes when something you did not do appears to be working better than something you did. You start running numbers in your head, you start wondering, you start thinking maybe you picked the wrong side of this argument 3 years ago when it actually mattered. Here is the problem with that feeling. It is built on a comparison that almost nobody is doing correctly. The gold versus real estate debate is one of the most argued conversations in personal finance. It is also one of the most consistently misanalyzed ones, because almost everyone who makes this comparison is leaving out the single variable that changes the math so dramatically that the debate stops being close in the way most people think it is. And the people who understand that variable are quietly building wealth in a completely different league from the people who do not. My name is Jack, I am 56 years old, and I have watched this argument play out across multiple gold bull markets, multiple real estate cycles, and multiple generations of people making very different decisions with very similar amounts of money. Stay until the end. Because there is one specific scenario where gold genuinely wins this comparison and wins it convincingly. Most people who are currently buying gold are not actually in that scenario. Knowing which one you are in changes everything about what you should do with your money right now. Subscribe and hit the thumbs up if you came here for straight math instead of someone trying to sell you something. Quick note. I am not a financial advisor, and nothing here is financial advice. Now, before the numbers, one thing I need to say plainly that most content on this topic skips because it makes the video less shareable. This is not a video telling you gold is worthless. Gold just had its best annual performance since 1979. It rose 65% in a single year. It crossed $5,000 an ounce for the first time in history in January of this year. If you have been holding gold for the past 3 years, you have done extraordinarily well, and I am not going to sit here and pretend otherwise. What this video is about is one specific question that is different from whether gold has performed well recently. The question is this: for someone who is not already wealthy, who has a meaningful chunk of capital and a time horizon measured in decades, which asset builds more total wealth over that period? That is not the same question as which asset has had the better recent run. And the answer to the right question might surprise you. Let us start with the basic numbers, the version of this comparison most people are familiar with. Before we add anything complicated, over the past 30 years, gold has returned approximately 8% annually on average. That is a real number. It beats inflation consistently. It beats a savings account by a margin that compounds into something meaningful over decades. For an asset that requires zero management, no tenants, no maintenance calls, no property tax bills, zero active involvement from you at any point, 8% annually over 30 years is a genuinely respectable result, and I will not pretend otherwise. Real estate over the same period, residential and small commercial property across most major and mid-sized markets, has returned approximately 10 to 12% annually when you combine rental income with appreciation. Before we add any other variables, that gap alone matters enormously. The difference between 8% and 10% compounded over 30 years on $100,000 in starting capital is the difference between approximately $1 million and $1,700,000. $700,000 in additional wealth. From the same starting amount, the same time period, a 2% difference that most people describe as minor. When they see it on paper, it is not minor. $700,000 is not a rounding error, but here is where the comparison completely stops being a debate for anyone with access to both options. And this is the variable that almost nobody includes when they post comparison charts or make content about this topic, because when you add it in, the math does not shift slightly in real estate's favor. It shifts by a factor that makes gold's recent performance, like even this historic run to $5,000, look like a completely different conversation. The variable is leverage. When you buy gold, you buy gold. $100,000 buys you $100,000 worth of gold. Your returns are calculated on $100,000. That is the ceiling. That is the entire position. The math is simple and the structure is fixed. When you buy real estate, you typically put down 20 to 25% and borrow the rest. $100,000 as a down payment controls a $400,000 asset. Your returns, both appreciation and rental income, are calculated on $400,000, not $100,000. The bank's capital is working for you at the exact same rate as your own capital. Now stop. Before we go any further, sit with what that actually means in concrete numbers. If that $400,000 property appreciates at 10% annually, you gain $40,000 in year one on a $100,000 investment. That is a 40% cash-on-cash return before a single dollar of rental income is counted. On the same $100,000 in gold at 8% annual return, you gained $8,000, not $40,000. $8,000, 5 times less, from the same capital in the same year. The leverage structure does not slightly change this comparison, it transforms it. And it is the reason people who built serious wealth through real estate over the past 3 decades did not necessarily find better markets or make smarter individual decisions than people who bought gold. They used a financial structure that gold does not offer and cannot replicate. Now, I want to give gold a completely fair hearing here because the counter argument is real and it deserves a direct and honest response, not a dismissal. Real estate has costs that gold does not have: property taxes, insurance, maintenance, vacancy periods where the income stops but the mortgage does not, management fees if you hire someone else to handle tenants, which most people eventually do. Here's what those costs look like in actual numbers rather than vague warnings. Property tax on a $400,000 rental property runs approximately $4,000 to $6,000 annually, depending on location. Landlord insurance adds another $1,000 to $2,000. Maintenance and repairs on a reasonably maintained property average 1 to 2% of value per year, another $4,000 to $8,000. A property management company charges 8 to 12% of monthly rent. Add those together honestly, and the operating costs of a rental property run between 2 and 4% of the property value every single year. A property appreciating at 10% annually and costing 3% to operate is actually producing 7% net, which suddenly makes the basic comparison to gold's 8% look considerably closer than the gross numbers suggest. This is the honest version of the math, not the version most real estate advocates share when they are making their case. Property ownership is not free. It is not passive from day one. And anyone who tells you otherwise has either never owned a rental property or is leaving out the part where the water heater failed at 11 on a Friday night and the repair bill was $1,200 and the tenant needed somewhere to shower by Saturday morning. Gold has never once called you at 11 on a Friday night. That is a real advantage, and I am not going to pretend it is not. You can hold gold in a brokerage account and forget it exists for a decade. No tenant, no contractor, no insurance renewal, no emergency fund, sitting idle waiting for the next repair. The simplicity of gold is genuine, and it has real value for certain types of investors in certain types of life situations. The question is whether that simplicity is worth the structural disadvantage when you put the full math side by side over 30 years. And that answer depends entirely on which version of the math you are willing to look at, honestly. But there is one element in real estate's column that gold simply cannot replicate, regardless of how the cost calculation comes out. One element that changes the entire structure of what you are building and what it looks like 30 years from now. Monthly cash flow. A well-purchased rental property does not just appreciate in value while you hold it. It generates income every single month while the appreciation is happening simultaneously. That income, if redirected back into the asset or into additional assets rather than spent, compounds alongside the price appreciation as a completely separate engine of wealth creation. Gold generates zero monthly income. It sits, it appreciates or it does not. It protects purchasing power or it does not. But it produces nothing in the interim. No income arrives. No compounding begins until you sell. Over a 30-year hold, the rental income from a single well-located property can exceed the original purchase price of that property multiple times, entirely independent of whatever the property itself is worth at the end of the period. You are running two separate compounding engines simultaneously: price appreciation and income reinvestment. Gold runs one: silence and appreciation. Here's something that illustrates this better than any percentage comparison. A man I know spent his career working in engineering. Practical person, not someone who described himself as an investor or followed financial markets closely. In his early 30s, he bought a single rental property, a 3-bedroom house near a regional university in a mid-sized city. Nothing impressive. He put $22,000 down. The property generated modest positive cash flow from the first month, not dramatic money, $230 after the mortgage. He used that surplus to make additional principal payments every month without exception, slowly, consistently, month after month for almost 2 decades. By his early 50s, the mortgage was gone entirely. The property was generating approximately $1,900 monthly in net income with no debt against it. The property itself had appreciated to roughly 3 times the original purchase price. He told me he considered it nothing remarkable. He held an ordinary asset for an ordinary period of time and did not interrupt the math while it was running. He checked gold prices exactly once, in early 2025, when the price was crossing $3,000 an ounce and everyone with a phone had an opinion about it. He looked at the leverage structure, saw that gold offered none, bought a second rental property instead. He still drives the same truck he bought 12 years ago. He has not discussed his investments at a dinner party once in the past decade. He has not needed his engineering income for 2 years. The gold discussion never found him because he was not looking for excitement. He was looking for math that compounded in multiple directions simultaneously. Now here's where I need to be direct about gold, because there is a real and legitimate case for it and I have not made it yet. Gold wins this comparison in one specific scenario, and that scenario is more common than most people discussing this topic acknowledge. Gold wins when the alternative is not real estate. Gold wins when the alternative is money sitting in a savings account, a checking account, a low-yield instrument that loses 2 to 3% of its real value every year to inflation. Gold wins for someone who does not have the capital required for a meaningful down payment, who does not have the credit profile to qualify for a mortgage at reasonable terms, who cannot manage a property or is not in a life situation where real property ownership is practical right now. In that scenario, gold as an inflation hedge and long-term store of value is meaningfully better than doing nothing with that capital. 8% beats zero. It beats inflation. It beats the national average savings account rate by a factor that compounds into real money over 30 years. And critically, gold wins as a portfolio component, not as a replacement for real estate. As something you hold alongside productive assets because its price tends to move in the opposite direction from financial markets during periods of stress. When stock markets fall sharply and real estate markets freeze, gold tends to rise. That diversification function is real and it has a place in a thoughtful wealth building strategy, but that is a completely different argument than gold beating real estate head-to-head for someone who has genuine access to both options and a time horizon measured in decades. These are two separate scenarios that get constantly collapsed into one debate. And that collapse is why most people engaging with this comparison walk away with the wrong conclusion. Here is what most people get wrong when they look at this comparison. And I have watched this mistake made consistently across every version of this debate I have seen in 56 years. They look at recent performance and evaluate the asset. Gold rose 65% last year. That is the data point that drives the conversation right now. It is also almost completely irrelevant to the question of which asset builds more wealth over 30 years for someone making this decision today. Evaluating a 30-year asset on a 12-month return is like judging a marathon runner based on their first mile. The opening pace and the final result have almost no relationship to each other. The wealth building comparison between these two assets is not about which one had the better recent run. It is about which mathematical structure is more favorable over the time horizon that actually matters for someone who is not already wealthy. And that structure comparison, one compounding engine versus four, no leverage versus controlled leverage, zero monthly income versus compounding cash flow, one exit point versus 30 years of simultaneous appreciation and income, is not a close comparison when you lay it out honestly. Real estate builds wealth through leverage, price appreciation, monthly cash flow, and automatic equity growth as the mortgage is paid down every month, whether you think about it or not. Four forces running simultaneously. Gold builds wealth through one force, price appreciation alone. 4 versus 1. For someone with a long time horizon and real access to both options, this is not the close debate that the current gold price makes it feel like. The phone is still buzzing, the all-time high screenshot is still sitting in your messages, your brother-in-law is still waiting for a reply. Here's what you send back. Run the actual math. Include leverage. Include cash flow. Include all four forces. Compare 30 years, not 12 months. Then decide which structure you want working for you while you sleep. The emoji can wait. The math cannot.